If you are over 50, investing priorities change naturally. Protecting capital becomes more important, yet growth still matters. The challenge is balancing caution with opportunity. This stage rewards calm thinking, realistic expectations, and strategies designed to survive volatility without sacrificing long-term progress or peace of mind. At this stage of life, time feels different. Recovery periods matter more than rapid gains. Investing decisions must respect shorter horizons while still allowing compounding to function. The goal is not maximum return, but dependable progress that avoids irreversible mistakes caused by excessive risk or emotional reactions. Capital protection starts with mindset. Losses hurt more later in life because recovery time is limited. This does not mean avoiding growth, but it does mean avoiding unnecessary risk. The focus shifts from chasing upside to preserving flexibility and staying invested through uncertainty. One principle is margin of safety. Buying with a cushion reduces the impact of errors and market swings. A margin of safety protects capital first, then allows growth to occur gradually. This principle becomes more valuable as tolerance for drawdowns naturally declines. Diversification becomes more intentional after 50. It is no longer about owning everything. It is about balancing income, stability, and growth. Proper diversification reduces reliance on any single outcome while maintaining exposure to long-term wealth creation opportunities. Another priority is liquidity. Having accessible funds reduces pressure during market stress. Liquidity allows patience, preventing forced selling at unfavorable times. When basic needs are covered, investment decisions remain calm and deliberate rather than reactive or fear-driven. Debt management also becomes critical. High leverage magnifies stress and reduces flexibility. Reducing or eliminating unnecessary debt strengthens resilience and protects cash flow. Lower financial pressure improves decision-making and allows investments to remain untouched during downturns. Volatility feels different later in life. Price swings are not just numbers. They represent lifestyle security. Understanding this emotional shift helps investors design strategies that can be held comfortably, even during extended market declines or economic uncertainty. Income-focused assets gain importance. Reliable income reduces dependence on selling assets for living expenses. This supports capital preservation while allowing growth assets time to recover and compound without interruption from withdrawals. Another idea is simplicity. Complex strategies increase monitoring and stress. Simpler portfolios are easier to understand and maintain, reducing emotional fatigue. Simplicity supports discipline, which becomes more valuable than sophistication as priorities shift. Risk tolerance often declines gradually. Ignoring this leads to poor decisions later. Honest reassessment allows portfolios to evolve naturally. Adjusting risk early prevents panic-driven changes during market downturns, which often cause permanent damage. Protecting capital does not mean avoiding equities entirely. It means selecting exposure carefully. Quality businesses and broad diversification can still provide growth without excessive volatility. The balance matters more than aggressive positioning. Patience becomes a strategic advantage. Over 50, avoiding mistakes contributes more to outcomes than chasing marginal gains. Fewer decisions, made thoughtfully, often outperform constant adjustment driven by fear or headlines. Another principle is planning withdrawals in advance. Knowing where income will come from reduces anxiety. Clear withdrawal plans prevent emotional selling and protect long-term growth assets from being liquidated at poor times. Inflation remains a silent threat. Capital protection must account for purchasing power. Growth assets still play a role in defending against inflation, even when overall risk exposure is reduced. Behavioral discipline becomes central. Emotional reactions cause more harm than market cycles. Staying calm during volatility protects both capital and confidence, allowing long-term plans to remain intact. Avoiding speculation is critical. Speculation increases downside without improving security. After 50, the cost of large mistakes outweighs the benefit of occasional wins driven by high-risk behavior. Another focus is aligning investments with lifestyle needs. Portfolios should support how you want to live, not create constant anxiety. Alignment improves satisfaction and reduces temptation to abandon plans during stress. Regular reviews matter, but constant changes do not. Periodic check-ins ensure alignment with goals. Overreacting to short-term performance often damages results more than temporary underperformance. Capital protection also includes health and energy. Stressful financial decisions drain focus. A calmer strategy supports better overall well-being, which indirectly improves financial outcomes over time. Expectations should be adjusted realistically. Growth will be uneven. Accepting this reduces disappointment and prevents unnecessary changes driven by impatience or fear. Another key is reducing dependency on market timing. Timing mistakes are costly later in life. A structured approach focused on consistency outperforms attempts to predict short-term movements. Cash flow visibility is essential. Knowing expenses and income sources reduces uncertainty. Clarity improves confidence and supports patient investment behavior during market fluctuations. Protecting capital also means protecting confidence. Large losses damage trust in plans. Preserving confidence allows investors to stay engaged rather than withdrawing entirely after setbacks. Flexibility matters more than speed. Having options reduces pressure. Flexibility allows adjustments without abandoning long-term intent or reacting emotionally to temporary conditions. Learning continues after 50. Staying informed supports better decisions. The difference is filtering information carefully to avoid noise that triggers unnecessary concern or action. Another principle is focusing on what you can control. Markets are unpredictable. Behavior, costs, and allocation discipline remain within your influence and matter more over time. This stage rewards steadiness. Calm, measured decisions protect capital while allowing growth to continue quietly. The objective is sustainability, not excitement, and progress without unnecessary stress. As life advances, uncertainty feels heavier. Market swings intersect with personal responsibilities, making emotional resilience essential. A well-structured plan absorbs uncertainty without demanding constant attention. This reduces stress and preserves confidence, allowing investors to remain committed even when conditions challenge assumptions or patience. Another priority is protecting downside first. Growth matters only if capital survives. Avoiding severe losses preserves optionality. When downside is controlled, upside becomes a bonus rather than a necessity, allowing decisions to remain calm instead of pressure. Asset allocation deserves careful thought. Over 50, allocations should reflect both growth needs and stability requirements. A thoughtful blend reduces volatility while still participating in long-term expansion. Balance replaces aggression as the guiding principle. Quality matters more than speed. Reliable businesses, strong balance sheets, and durable demand support steadier outcomes. Quality reduces surprises that trigger emotional responses. This steadiness becomes increasingly valuable as tolerance for prolonged drawdowns decreases. Broad diversification across sectors and geographies lowers dependence on any single outcome. This reduces anxiety during localized downturns. Diversification is not about complexity. It is about resilience across unpredictable economic environments. Income planning continues to grow in importance. Predictable income streams reduce reliance on selling assets. This protects capital during downturns and allows growth assets to remain invested, improving long-term outcomes without increasing stress. Another principle is reducing decision frequency. Fewer decisions lower the chance of emotional mistakes. Systems designed in advance replace reactionary behavior. This approach preserves capital by minimizing interference during volatile periods. Market narratives intensify with age-related concerns. Fear-based messaging targets investors seeking safety. Filtering narratives protects discipline. Calm analysis prevents overreaction to stories that exaggerate risks or promise false security. Rebalancing should be purposeful. Adjustments restore balance rather than chase performance. Scheduled rebalancing enforces discipline and prevents drift toward excessive risk or excessive conservatism over time. Taxes quietly affect outcomes. Efficient structures preserve more capital for compounding. Over long horizons, minimizing unnecessary tax drag contributes meaningfully to stability and growth without requiring higher risk exposure. Another focus is estate and legacy thinking. Decisions increasingly consider heirs or long-term beneficiaries. This perspective encourages caution and sustainability, aligning investments with enduring goals rather than short-term performance metrics. Risk capacity differs from risk tolerance. Even if tolerance remains high, capacity often declines. Recognizing this distinction prevents overexposure that could force undesirable actions during market stress. Avoiding forced decisions becomes critical. Forced decisions usually occur at unfavorable times. Adequate liquidity and planning reduce the chance of selling assets under pressure, protecting both capital and confidence. Another principle is aligning investments with sleep quality. If volatility disrupts peace of mind, adjustments are needed. Rest supports clearer thinking and better long-term discipline. Inflation must be addressed thoughtfully. Excessive conservatism erodes purchasing power. Growth assets still play a role, even as overall risk is moderated. Balance remains essential. Costs deserve attention. High costs compound negatively over time. Reducing unnecessary FEs preserves returns quietly and reliably, supporting both protection and growth objectives. Emotional resilience improves with preparation. Knowing plans in advance reduces anxiety. Preparation replaces worry with clarity, improving decision-making during inevitable periods of market turbulence. Avoid chasing yield blindly. High yields often carry hidden risks. Sustainable income matters more than headline numbers, especially when capital preservation is a primary objective. Another habit is documenting intentions. Written plans anchor behavior during stress. Documentation prevents impulsive changes and reinforces discipline when emotions attempt to override logic. Reviewing assumptions periodically keeps plans relevant. Life circumstances change. Thoughtful review supports alignment without encouraging constant adjustments or reactive behavior. Market cycles repeat. Experience provides perspective. Remembering past recoveries helps maintain confidence during downturns, reinforcing patience rather than panic. Over 50, investing becomes less about proving skill and more about preserving independence. Independence comes from stability, not speculation or frequent trading. Maintaining flexibility allows adaptation. Flexibility does not mean constant change. It means preserving options without sacrificing long-term intent. Avoid binary thinking. Markets are rarely all good or all bad. Nuanced thinking supports balanced decisions and prevents extreme positioning driven by fear. Another principle is separating emotions from outcomes. Outcomes fluctuate. Behavior endures. Focusing on behavior preserves consistency when results temporarily disappoint. Confidence should remain grounded. Overconfidence increases risk exposure unnecessarily. Humility supports caution and long-term participation. The role of patience deepens with age. Patience protects capital by avoiding impulsive responses to short-term noise. Capital protection also means protecting habits. Habits determine consistency. Strong habits reduce reliance on willpower, which weakens under stress. This phase emphasizes durability. Durable strategies survive market cycles and personal changes. Durability supports quiet growth without demanding constant attention or emotional energy. As retirement approaches, protecting confidence becomes as important as protecting capital. Confidence allows investors to stay engaged rather than retreating after setbacks. A strategy that supports confidence reduces the likelihood of abandoning long-term plans during periods of uncertainty or volatility. Behavioral mistakes become more costly later in life. Recovering from large errors requires time that may no longer be available. Avoiding major losses matters more than capturing every possible gain. Preservation supports longevity of wealth and peace of mind. Long-term growth after 50 relies on staying invested, not chasing returns. Staying invested requires emotional stability. Emotional stability is supported by structures that limit surprises and reduce exposure to extreme outcomes. Another principle is clarity of purpose. Knowing why wealth exists shapes how it is managed. Purpose guides decisions when markets fluctuate, preventing reactionary changes driven by fear rather than thoughtful intent. Withdrawal planning deserves ongoing attention. Poorly planned withdrawals damage both capital and confidence. Structured withdrawal strategies allow assets to recover after downturns, preserving long-term growth potential while supporting living needs. Sequence risk becomes more relevant with age. Losses early in retirement have outsized impact. Reducing exposure to severe drawdowns protects sustainability. This does not eliminate growth, but it emphasizes smoother paths rather than aggressive volatility. Another focus is aligning investments with realistic spending patterns. Honest assessment of expenses prevents unnecessary risk-taking. When spending needs are clear, portfolios can be structured calmly instead of optimistically. Cash reserves serve a strategic role. They buffer against market downturns and reduce reliance on selling assets. Proper reserves increase patience, allowing growth assets to remain invested through unfavorable periods. Longevity risk must be acknowledged. Living longer increases the need for growth. Completely eliminating growth exposure creates its own risk. Balanced exposure supports purchasing power over extended retirements. Healthcare uncertainty also influences strategy. Unexpected costs can disrupt plans. Preparing for these realities reduces pressure on investment decisions and preserves flexibility. Another principle is avoiding emotional anchoring to past prices. Markets evolve. Anchoring creates regret and poor decisions. Forward-looking thinking supports healthier behavior and better alignment with current realities. Over time, simplicity becomes a strength. Fewer holdings are easier to monitor and understand. Simplicity reduces anxiety and supports disciplined behavior when markets become turbulent. Diversification should evolve, not disappear. Adjusting exposure thoughtfully reflects changing priorities. Abandoning diversification entirely increases risk unnecessarily. Avoiding unnecessary complexity protects mental energy. Cognitive overload increases mistakes. Clear structures reduce stress and support better decisions. Regular communication with family or partners matters. Shared understanding prevents conflict during market stress. Alignment improves confidence and reduces emotional decision-making. Another key is adaptability. Without panic, adjustments should be gradual and deliberate. Panic-driven changes often cause lasting damage. Experience becomes an asset. Having lived through cycles provides perspective. Remembering recovery periods reduces fear during downturns. Markets will continue to surprise. Accepting this reality prevents frustration. Prepared investors expect surprises and plan accordingly. Protecting wealth also means protecting routines. Stable routines support consistent behavior. Consistency reduces emotional noise. Financial independence relies on predictability. Predictable income and expenses reduce anxiety. Reduced anxiety improves decision quality. Another principle is resisting urgency. Urgency often signals emotional pressure rather than genuine necessity. Slowing decisions improves outcomes. Growth continues through discipline. Discipline replaces ambition as the primary driver of success. Quiet consistency outperforms dramatic action. After 50, investing becomes less competitive and more personal. Success is measured by stability, freedom, and peace of mind. Avoiding envy matters. Comparing to others introduces dissatisfaction. Satisfaction supports patience. Accepting trade-offs is part of maturity. No strategy offers all benefits. Choosing balance prevents regret. Confidence deepens when plans survive stress. Each cycle reinforces belief in the process. Confidence built through experience is durable. Ultimately, capital protection and growth coexist. Protection prevents ruin. Growth preserves purchasing power. Balance allows both. Warren Buffett's thinking emphasizes patience, quality, and discipline. These principles remain effective regardless of age. but they become especially valuable when time and recovery capacity are limited. Over 50, success comes from avoiding large mistakes, staying invested calmly, and allowing time to work. Wealth grows quietly when behavior remains disciplined. The goal is not excitement. The goal is sustainability. Sustainable strategies protect capital, support growth, and allow investors to live confidently without constant financial worry.